Hello, and welcome to the Ottawa chapter of CPA Ontario's annual tax update. On behalf of our chapter chair, Lisa Allen of CRA, and our programs committee chair, Richard McNeil of Otis Group, I'd like to thank you for joining us today. My name is Dean Blatchford. I'm a tax dispute resolution and litigation lawyer with Blatchford Tax Law, and I'll be your MC for the next hour and a half. This session promises to bring you the most up-to-date information on the most pressing topics facing Canadian accountants today, from access to justice for tax matters, to technical and administrative trends, to the use of trusts, and to tax planning strategies for 2022. And this will all be brought to you by some of Canada's foremost authorities on tax issues. Before we get started, I want to acknowledge that I'm speaking today from the unceded and unsurrendered Algonquin and Anishinaabe territory. And a few housekeeping matters before I introduce our first speaker. First, there is a recording of this presentation, and we'll be sending that to you with all the slides after the presentation. We've dedicated all our time in this next hour and a half to our speaker's presentation, so there's not a Q&A. We will be sending you a survey at the end of this to get your feedback, and we look forward to hearing from you on that. Our first speaker is a judge with the Tax Court of Canada. She's also one of Ottawa's very own, having graduated from the University of Ottawa back in 1991 with a law degree and an MBA. After that, she was selected for the Tax Court of Canada's one-year clerkship program, and she's actually got the distinction of being the first person ever to go through that clerkship program and then be appointed as a judge of the tax court later in their career. But before her appointment, she had a 26-year career in academia, teaching tax and corporate law at the University of Ottawa. During that time period, she took a 2-year secondment to work for the Department of Justice in the tax litigation section. She also moonlighted for 10 years as an adjudicator on 2 administrative tribunals for the healthcare sector. She also started a program when she was a prof that I think is really cool. She paired volunteer law students with self-represented litigants before the tax court. So Canadian taxpayers who were making an appeal to the tax court but didn't have a lawyer, and those law students would help represent those taxpayers before the court. So very cool stuff. Those of you who attended our 2017 edition of this event, our annual tax update, will recognize this speaker because she was actually a guest at our head table back then. The next year, she was appointed as a judge to the tax court. So was it her illustrious 26-year career in law and academia that got her appointed, or the profile she received from being a head table guest at our event? We'll never know. But regardless, we're lucky to have her here today. Please welcome from the Tax Court of Canada, the Honourable Justice Saint-Hilaire.
Well, thank you, Dean, for your very kind introduction. Maybe it was the work that we did together working with the pro bono students that made the difference. Who knows?
It was amazing, yeah.
And good afternoon, everyone. It is with absolute pleasure that I was able to accept Dean's invitation to speak at your conference today. And I understood from my conversation with Dean that some of you might appear before the tax court from time to time, and for others it might be more incidental. But I thought I'd take a few moments to speak a little bit about our court. And although our court's jurisdiction covers over 12 statutes, the lion's share of what we do involves legislation with which you're very familiar, and that's the Income Tax Act and the GST portion of the Excise Tax Act. Now, as an itinerant court, we travel around the country to hear matters in more than 50 locations. So on any given day, judges of the tax court are traveling across Canada to large cities such as Montreal, Toronto, and Vancouver, but also to smaller locations. And in Ontario, that would include places like Timmins and Thunder Bay. But we also travel to much smaller and more remote communities. For example, at one time, I traveled to Baie-Comeau, about 8 hours or 10 hours northeast of Montreal. And all I can say is that there's no easy way to get there. Now, in light of this, it will not surprise you to hear that we pride ourselves in being a very accessible court, dealing with people's real problems, both big and small, in their own communities. And this leads me to speak a little bit about access to justice, a phrase that's been used and some might say overused in the last few years. and that has become sort of a mantra for lawyers and judges and legal academics. And having said that, we need to ensure that the phrase retains its real meaning. Now, issues surrounding access to justice are not a new problem. There never was a time when the ordinary person could easily afford legal representation. However, accessing the justice system has become ever more remote for most ordinary citizens who likely are the kind of people who come to you for assistance with their tax matters. Now, defining and more importantly, addressing the barriers to access to justice is a very complex, multifaceted problem that requires tackling it from various vantage points. Now, two of those barriers include the high cost of litigation, of course, but also the lack of awareness and knowledge of legal obligations and rights. And although legal aid seeks to alleviate some of the financial barriers faced by people who cannot afford legal services, it barely addresses the problem. Most Canadians who work at minimum wage, even if they're working full-time, will not be able to qualify for legal aid. So this leaves us with a system where at one end of the spectrum, we have the wealthy who can afford costly legal services and who always have been able to afford them. And at the other end, the poorest who will be able to get some legal aid, perhaps insufficient, but some help there. Now, in between, we have the poor but not poor enough, and the middle class, who cannot access legal aid, but also may not be able to afford a lawyer. And this has very serious effects. In particular, and I'm thinking of areas of law, such as family law, where people are vulnerable and experiencing very difficult or facing very difficult issues, such as child custody and support. In addition, and more importantly for our purposes in Ontario, and I suspect in other provinces as well, legal aid is not available for those with tax problems. So in some cases, people will simply choose not to seek legal remedies to which they may be entitled. Many others will choose to represent themselves at various stages of the legal process, including before the courts. So as judges of the tax court, we all hear matters involving self-represented litigants, which most often seek to use or choose to use our informal procedure route. And as you may know, and as the name implies, this procedure skips the more formal steps that one would encounter in the general procedure. The rules of evidence are relaxed, and it is expected that decisions will be rendered more quickly. And it's fair to say that, generally speaking, the issues in these appeals are less technical and less complex, but it is also true that the legislation can be difficult to appreciate for anyone without training in law or accounting. So I thought I'd take just a moment to give you a quick breakdown of the appeals before our court and the percentage of self-represented litigants. So about 45% of the matters in our court are IT and GST appeals heard under the informal procedure. So that's almost half the appeals that come before us. And of those informal procedure appeals, 83% are self-reps or persons represented by agents, which would include representatives like yourselves. And unsurprisingly, we have the almost opposite situation for general procedure matters, where only 13% are self-reps. Of course, we'd get a totally different picture if we were to look at appeals from the dollar amount that's involved. But nonetheless, I would suggest that hearing matters involving self-reps is an important part of what the court does, and an important contribution in reducing barriers of access to justice. And we must always keep in mind that notwithstanding the dollar amount that some might find insignificant, it is, for those litigants, the most important case in the world. And that has been a source of motivation in making our court processes more simple, convenient, and accommodating. I would like to speak to the other barrier I raised earlier, that of lack of knowledge and about one's legal obligations and lack of legal information, or worse, access to a lot of misinformation. And there are various ways to address this problem, and there are several ongoing initiatives to do so, including better court websites, better information posted on social media, all hopefully avoiding legalese. But in my view, this is an area where you as accountants can provide valuable service to your clients. I know from experience that even taxpayers who choose to self-represent before the tax court did have contact with an accountant at some point prior to that. And I have heard several appeals involving business persons who perhaps could have avoided ending up in our court had they had better knowledge of their obligations under the legislation. Now, understandably, businessmen and women are focused on running their business and making it profitable. No small feat generally, and even more challenging in the context of the pandemic. The pandemic has hurt everyone in various ways, but it has, I think, created extra pressure on business persons. And as accountants, you possess knowledge and expertise, and you are in an ideal position to provide valuable service to your clients to help them do things right, particularly, although not exclusively, when commencing their businesses and setting up what is hopefully a robust accounting system. And I know that you provide value to your clients that go way beyond tax-related services, including helping them grow their businesses and make good strategic business decisions. However, they can also benefit from your advice to ensure compliance and to avoid penalties, reassessments, objections to the CRA, and appeals before our court. And I'll give you just a few examples. As you all know, the regulations providing the mandatory documentary requirements for successfully claiming input tax credits are extremely detailed. Some might say mind-numbing detail. And this is an area rich in disputes between taxpayers and the CRA. I actually heard a matter this morning that involved the disallowance of input tax credits. And you might be surprised at how easy taxpayers make it for the CRA to disallow the ITCs just because they did not collect simple yet prescribed information. And I would suggest as accountants, you are in a very good position to educate your clients about the nature of these requirements. And this would go a long way in avoiding disputes, sometimes disputes that occur years later when it is difficult to put the necessary evidence together for a successful appeal. And as another example of your involvement with your clients' tax issues, I would like to speak to your role in the appeal process. As you know, by the time a matter comes before a judge of the tax court, it has gone through several administrative steps or hoops, including potentially audits and certainly an objection. And as accountants, you are involved often in your clients' audits and are called upon to speak to CRA officers who take notes and create records of these conversations. I have heard appeals where those notes were introduced into evidence to disprove what a taxpayer is suggesting was their state of mind at the time the transactions were entered into. Now, in addition, these records may be used to test your credibility if and when you testify before the court. So I would suggest it is important to be mindful of that when addressing comments to the CRA, either in written or verbal form. I will end by emphasizing the very important role that you play as experts in your fields and as professionals who are involved in your clients' businesses, whether sporadically or on an ongoing basis, and who are in an optimal position to assist them in avoiding the many pitfalls tax legislation has to offer. As well, and for whichever reason when these pitfalls are not avoided, you also have much to offer when you are called upon to assist counsel like Dean in preparing to argue a case before the court, but hopefully with a view to settling the case. As Justice Bowman, the former Chief Justice of the tax court, once said, a settlement that makes both sides a little bit unhappy or a little bit dissatisfied is the best possible result. And Dean, before I give you back the floor, I hope you will not misconstrue my comments about the cost of litigation as a barrier to access to justice. I would be remiss if I did not acknowledge the importance of the valuable service you provide as counsel to your clients and to the court in assisting judges in conducting trials more efficiently. Enjoy the rest of the conference, everyone. And again, thank you, Dean, for the opportunity to speak today.
Justice St. Hilaire, thank you so much for that. It's very important for us to be reminded of the role that we all play in providing Canadians with access to justice. We're lucky to have you back 5 years later, and Canadian taxpayers are lucky to have you on the bench. Thank you so much.
Thank you. Enjoy.
All right. Our next speaker comes to us from Vancouver, British Columbia. She is the Director of Tax, Education, and Publications for Video Tax News. And for the rare view of a few of you who don't know what Video Tax News is, it provides accounting. It provides tax information to Canadian accountants across the country. She will be embarrassed to have me say this, but the date and time of this event has been selected specifically to fit into her schedule, which is chock-a-block of sessions that she is providing along with her colleagues to Canadian accountants across the country. Her and her colleagues at Video Tax News pour through every government announcement and CRA publication as if it's the latest Harry Potter novel. They then distill and disseminate that information in a way that's accurate, informative, engaging, even funny. They also collect data from their accountant participants through polls, and that data is extremely valuable, and it's that data that she's going to share with us today. So please join me in welcoming from Video Tax News, Caitlin Butler.
Thanks, Dean. Pleasure to be here. And also thanks, Justice St. Hilaire. Fascinating presentation. I was just so sucked into it. I almost forgot that I had to start talking shortly. So thanks for the wake up, Dean and Ella, on the background chat. And yes, I am going to spend about the next 20 minutes talking about some of the trends we're seeing for these owner-managed businesses with a focus on personal tax topics. Now, Dean mentioned we're going to be discussing, or I'll be discussing some of the poll results. Now, just to put that in perspective, the majority of poll results that I've included in this presentation, they were taken in January, February of this year at our personal tax update courses, and we have well in excess of 1,000 practitioners, tax planners, preparers who were involved in these polls. So lots of great information there. A couple other polls I've pulled from other sessions we've done at different venues and different parts of the years, but I've noted that in the slides. So Dean, what do you say?
Well, it sounds exciting. I'm happy to hear how things in BC are going well so far.
You know, it is fascinating. And I got to say, just recently, and I'm going to talk about this in the course, but we saw a letter campaign, a project kickoff in BC. And I think, you know, having exposure to kind of different jurisdictions is very helpful, because quite often when we see something get going in one area, we do see it spread across the country. So I'm excited to talk about that chapter of the Harry Potter novel, i.e. these education CRA compliance campaigns in this discussion.
Great. Take it away.
All righty. So let's, Khalid, if you wouldn't mind popping up my slides onto the screen, that would be fantastic. Lovely. Trends, projects, hot topics. And let's just dive right into this. So we're talking about some real estate issue. Clearly, CRA is concerned about that. They have been communicating this. The broader government is concerned with tax leakage in respect of real estate transactions. And I wanted to mention one of the issues that came up. It was way back in 2016, where the Department of Finance, and we have a rule change, which basically said that if you want to get access to the principal residence exemption, you need to designate it as such on your tax return. So one of the problems practitioners were facing is that maybe you got a new client, you looked at their books and records, you looked at their tax returns, you realized, holy smokes, they disposed of their principal residence. They thought they got the principal residence exemption, but they never designated it as such on their tax return. So now we're trying to clean up the mess. And if you don't designate, you don't get the PRE. So CRA has said, you know what? This is a new rule. We're going to be accommodating in allowing these late designations. We're going to be accommodating in waiving those penalties, $100 per month up to a cap of $8,000. So we thought we'd ask this poll. It's up on your screen now. So what is your experience with CRA in accepting these late designations? And I was really happy to see the results here. About 9% of the practitioners had, yes, that positive experience. A couple percentage so-so. We didn't have enough people to hit an actual percentage point in the results here for a negative, but we did have a couple one-off practitioners having that challenging experience with the CRA. But suffice it to say, if you need to make one of these late designations, as long as you don't have any kind of egregious retroactive kind of tax planning component to asking CRA for their administrative relief here, we do see pretty positive success with the CRA. Now, the one other issue we have seen pop up on a number of occasions is where we have a practitioner who's asking CRA for relief. CRA generally expects that you provide payment for the penalty upfront with your application. And then at that later point in time, if they accept your late designation, in some cases, they'll waive that penalty. Now, in those cases, we've seen a couple practitioners who have noted that they haven't actually got the check back from the CRA in respect of that penalty waiver. And what we've seen practitioners do is just go on to the CRA accounts, and quite often that amount they previously paid is just sitting in one of the CRA accounts. So if you are missing that kind of reimbursement of your prepaid penalty, go online, check it out, and ask for that amount back. Now that's going to take us to our next project that we're seeing. I alluded to it right in the introduction. It's the Principal Residence Exemption Education Letter Campaign. Right now, it's focused in BC. And what we're seeing is taxpayers who have claimed the Principal Residence Exemption getting these education letters. And CRA is basically saying, we're concerned that people are not properly claiming the Principal Residence Exemption. We see you've claimed the PRE, please review your return and adjust it as necessary. Now, what are the triggers? Who's specifically getting these letters? We've seen a couple categories of taxpayers. One category would be where we have a taxpayer who has more than one property sale in 2018, 2019, where they claim the Principal Residence Exemption. Presumably here, CRA is looking at quick property flips. And the other category of letter we're seeing is where someone has claimed the Principal Residence Exemption, but has also reported a reduction in gross rental revenue. So here, CRA is presumably concerned about claiming the PRE inappropriately in respect of a rental property. Now, the other interesting aspect of these educational letters is that the CRA said, you know what, we're going to follow up with a phone call, and we're going to discuss any issues that you might have with respect to the Principal Residence Exemption. So you think it's pretty innocuous. It's an excellent service. If you do want to get a bit more information, CRA has specific questions they're asking, but we have observed or at least been notified by one agent that said, if based on these conversations, based on what's on the file, we perceive it as a high-risk file, we can recommend it be elevated to audit. So if this letter campaign spreads outside BC, heads up on those phone calls. If it's perceived as higher risk, it could create more challenges for your taxpayer. And I also got to say, is this an indication of further activity in real estate? CRA is watching what's going to happen with these letters, and perhaps they are going to focus their activities maybe on this area or on other areas moving forward. Now, that's going to take us to our next topic, another area we're seeing lots of interest in from both our clients, accountants, and the CRA, and it has to do with crypto transactions. Historically, it's funny to say historically in the context of cryptocurrency, but traditionally we see cryptocurrency used as more of an investment tool. However, more recently, we're seeing a shift toward transactional use of cryptocurrencies. I'm thinking of the trucker convoy recently here in Ottawa, when we couldn't use more traditional means of raising funds. We had bank accounts being frozen. Well, then we started looking at, raising money through Bitcoins, other crypto assets. We're also seeing this issue in the war in Ukraine. You want to support the Ukraine government directly? You can send them Bitcoins, Ethereum, other crypto transactions. We also see it on the other side of the border in Russia. So more and more, we're seeing these crypto transactions creeping into everyday life in a more transactional way. And actually, just earlier this morning, my colleague Joe sent me an article where President Biden said, you know what, we are going to issue an executive order on government oversight of cryptocurrencies because they also perceive this as being a heavy risk area. So it's no surprise that CRA is concerned with transactions in this world, and we are likely going to be seeing more activity. But that's going to take us to our next poll here. What has been happening over the last couple of years? Have you seen a question in your firm's client base related to digital or cryptocurrencies? And when we look at these results, I was actually quite surprised at the prevalence of these questions. Nearly 1 in 10 of us are getting a question from CRA on cryptocurrencies. And there's lots of potential issues that as a firm we should be thinking about as we are seeing these transactions more. We are seeing CRA's interest in this area area increase. As a firm, I'm thinking, is this an issue where we need to have broad education across our firms? Does everyone need to know the basics of treating cryptocurrency transactions as they relate to tax issues? Or do we have perhaps one specialist in our firm who is the cryptocurrency ninja? I don't know. You got to figure it out as a firm. The other area where we are seeing questions is, these cryptocurrency transactions. Some of them can be fairly basic questions from a tax compliance perspective, but it can get very complicated very quickly. At what point does our firm draw the sand in the line and say, we can't deal with this anymore? We have to engage, or our clients have to engage in a specialist. These questions are going to arise more as we see more of these transactions occurring. The final issue, well, I don't want to say final, cryptocurrency is a can of worms, but another issue we're seeing here is related to the T1135. Does this, having these assets, does that trigger a T1135 filing requirement? CRA has said, yes, we think it's specified foreign property, but the question the accounting firms are dealing with here is, where are these cryptocurrencies? They're kind of everywhere and nowhere. Is it in Canada, or are these crypto assets held abroad, which can trigger that 1135 filing requirement? We got to be talking about this, figuring this out as a firm. I have a couple slides here talking about CRA activity related to COVID benefits, more for your reference here, but we do have that activity going out looking if you are actually eligible for CERB, CRB, and we actually are starting to see more judicial reviews of CRA's decisions to deny these CERB benefits. Now that's going to take us to employees working from home. We saw a lot of it in 2020. We saw a lot of it in 2021, and we're probably going to be dealing with this as we're filing our personal tax returns. Now, we know the temporary flat rate method is still available for our 2021 personal tax returns. We have a higher bump to that maximum deduction of $500. So the question is, okay, what did we do last year? And are we going to be having a similar approach this year? So as you look at the screen, I don't think it's a huge surprise to anybody, but about 85% of us mostly use the temporary flat rate method for claiming home office expenses for employees last year. A few percentage points used detail. We had 6% used both approaches depending on the client. Few percentage didn't bother with the new claims. That's a little bit of a scary one. Money left on the table, and then a few not applicable. So what did CRA do when they saw these mass claims of home office expenses? And we saw 77% of practitioners not being questioned overall, unsurprisingly, because there was that big focus on the temporary flat rate method. If we did see questions, there was a heavy focus on the detailed method. 9% of us were mostly seeing questions on the detailed method. Interestingly, as we were presenting these courses all across the country, for whatever reason, whenever we were presenting in Ontario, that option B, that focus on detailed method, tended to be much higher, almost double the number in Ontario. We're not quite sure why, but an interesting trend nonetheless. Let's go on to the next one. So moving forward, as hopefully we start to emerge from this pandemic or move into the next phase, endemic, whatever, what are we going to be doing as a firm related to our employees working from home? This poll was conducted in the fall, so numbers may have changed, but it gives you a bit of an idea. So for the accounting firms polled, about a third of us, just under a third of us, plan to be fully in office as we move past this pandemic. 34% mostly in office with some limited remote work. 8%, we're doing a 50-50 split. 8% mostly remote with some limited in office. Just a few percentage points, 3 fully remote. 9, I was surprised at that number, but 9% where each individual decides, pardon me. And then we had 6% remote before pandemic. We're staying remote after the pandemic. So when I look at these numbers, I'm seeing probably a pretty significant shift to more remote options post-pandemic. And I think that makes sense. We realized, whoa, we can work from home. We can work from the basement and still be productive. Now, there are a couple specific issues that may arise related to our employees or staff working from home. And I've noted a couple on the screen here specific to the tax and accounting industries. I mean, there's a whole host of other issues that we need to be considering. That's beyond the scope of today's presentation. One item that we get lots of questions on is permanent establishment. If we have permanent establishment issues, if our office is based in Ottawa, but one of our staff members is working from their cottage in Atlantic Canada in PEI, the question is, do we have a permanent establishment in PEI such that we need to allocate some of our business, our corporate income to Prince Edward Island? And the answer is, well, it depends. If that individual working from PEI has the general authority to contract on behalf of the business, on behalf of the corporation, then yeah, we're dealing with a permanent establishment issue. So when I'm looking at that, we're looking more at higher level employees, managers, executives that can trigger this PE issue, but it is absolutely something we need to be thinking about. Another issue we're looking at, it's not on your slides, but the whole concept of payroll withholdings. Have we even looked at what the withholding requirements are for payroll being paid to someone working in Prince Edward Island? Also, provincial payroll taxes. We're pretty familiar with the payroll taxes here in Ontario, but if we have too many people working in another province where they also have a different payroll tax regime, have we considered that? Just a few issues to be thinking about as we allow our employees to work from home. And then you smack in an international or a national boundary in there where you have an employee working from their vacation home in Florida. Wow, it gets much more complex. Now, one opportunity that we're seeing is if we need to, build up our staff, if we allow our people to work remotely, you're going to be able to look not just at the Ottawa region for experienced tax practitioners, accounting practitioners, you can look much broader. So we are seeing some opportunities there. That's going to take us over to COVID-19 benefits. Just the situation where our client is a subject of fraud, got a T4A issued to them, and they didn't get served CRB, and we're trying to fix it. How long is it taking to fix it? Not good results here. We had 8% where it's taking more than 6 months, half a year to get those T4A slips fixed. And actually, I've spoken to a number of individuals that are in that category, and we are approaching a year to get those T4A slips fixed. So it's going to happen again this year. Heads up, just be patient. And it's just a reality here. This is a really fascinating issue we saw this year as well. The teacher, early childhood educator teacher credit for the school supply tax credit. We saw enhancements this year. We also saw the introduction of essentially the carbon tax rebate for farmers. Well, both of those provisions were included in Bill C8. They hit our 2021 personal tax returns. However, C8 hasn't received royal assent. So what do we do when we file our tax returns this afternoon or a little bit later in the day when we get back to our office? And CRA has said that they will not process tax returns that have this enhanced eligible educator school supply tax credit or the carbon tax kind of rebate for the farmers until Bill C8 receives royal assent. So as a firm, we need to figure out how are we going to deal with it. So we did this poll actually just a couple days ago. I was teaching a course out in BC. What is our strategy when we have T1 returns where we want to claim that enhanced amount? And we had 26% of the room file as normal without the claim, 26% file as normal without claiming the amount, presumably amending the claim afterwards. We have 13% file with the claim, allow it to be put in the hopper at the CRA and processed and assessed whenever Bill C8 receives royal assent, 17% holding off until the earlier of legislation passing and the filing due date. A few people said, I'm out, don't process the return. Few, 14% don't know, and then a few not applicable. So just a heads up there. Now, the final few slides I wanted to go through, they're more firm administration, how you're dealing with some issues. So they're more here for reference, but I did want to mention this Bill C-208. This was done in the fall. This was the bill that allowed for us to use the capital gain exemption in a number of situations. However, there were a number of perceived holes in the legislation. We're waiting for the amendments. What are practitioners doing until we get those amendments potentially plugging the holes? And we saw about 2% open season, Wild West out here. Let's maximize those capital gain exemptions, 13% true business successions, 6% waiting for the amendments, 7% doing them with strong caveats, and then 20% not touching them, too risky. The final few slides deal with billing strategies. Are you more billing on the typical hourly based billing, fixed fee, or annual fee or monthly subscriptions? We have polls here looking at review engagements. What are your recovery rates? Likewise, what are your recovery rates for audit engagements? I'm not going to go over these in details because they speak for themselves. We have a poll here for what we're charging for T1, new T1 clients. A poll here, would we consider using an offshore service provider? 46%, almost half of us. No way, Jose. And then finally, this was the fascinating one. Do you know of any accounting firms or practitioners who have been the victim of a cybersecurity attack? Yes. 16% of us. We know of another firm that's been the victim. 9% of us, nearly 1 in 10. Yes, unfortunately, it's been our firm. Just a heads up. Keep those security systems in check, especially when we don't have time to deal with them during this T1 season. That is all I have for you today. Thank you for giving me this opportunity to speak about some of my learnings and my observations as to what's going on in the Canadian personal tax world. So back to you, Dean. Unless I can just keep talking, I can talk all day.
Caitlin, thank you so much for that presentation. It's very comforting to know that we're all kind of in this together, grappling with these same issues and having to figure this out along the way.
Yes, absolutely. It's no cakewalk for anybody.
No. Well, thank you so much for that. For those of you who aren't already plugged in and watching and receiving all the video tax news and stuff, I'm a big proponent of their monthly Life in the Tax Lane video. It's 10 minutes. It's jam-packed. I love it. Also, they have their seminars across the country, which we recommend as well. So thank you for that. And those slides that Caitlin mentioned at the end, you'll be able to see those when you pull up her slides once you receive them. Thank you, Caitlin.
Thanks.
All right. Our next speaker is one of the rising stars in Ottawa's tax scene. This year is her 10-year anniversary of receiving her CPA designation, and last year she was welcomed into the partnership at Hendry Warren LLP. She graduated from the University of Carleton with a Bachelor's of Commerce in Accounting, graduating with the highest honors and receiving the Senate Medal for academic distinction as well. She's got all 3 levels of the CICA in-depth tax course. And I was recently speaking to one of her colleagues at Hendry Warren who described her as a tax encyclopedia and spoke about how gracious she is in mentoring younger accountants as well. She's here today to update us on the use of trusts and trust planning. Please welcome from Hendry Warren, Jennifer Dawe.
Hi, Dean. Thank you so much for inviting me to speak here today. As I always say, I'm so pleased to hear from you when you want to, talk about a speaking engagement or play on a baseball team. I'm so glad to have your number ready when I need you for professional reasons, but I'd prefer to avoid it if I can, but a great resource as always.
Thanks so much, Jennifer. This topic of yours has been such a moving target over the past 5 years. I'm really glad that you've agreed to take it up for us, and I'm looking forward to hearing what you have to say about it.
Thanks very much, Dean. Yeah, I'll jump right in. So one of the reasons why I thought this would be topical for today is, as Justice Hilaire mentioned, and I think Caitlin did a great job of illustrating, the amount of compliance that it takes to run a business or even be a Canadian taxpayer is extreme. So some of you might notice in your practice, there's only a certain number of hours that our clients want to spend with their accountant a year. And I think with all of the programs and government programs, changes in legislation, interesting changes in the last 2 years, taking time to look at planning and structure and opportunities for the future sometimes become less of something that's on your mind or on a business owner's mind because they're so busy running their business. And then when it comes to accounting, it's deadlines and compliance. So a topic I think that provides a lot of opportunity for our clients. So in the context that I want to talk about today, I want to touch on owner-manager businesses because it's such a huge part of our practice. I want to talk about the effects of estate planning, and obviously that goes hand in hand. An opportunity with prescribed rate loans, given the opportunities that exist right now with the rate being 1%, limited time, going, gone, and the enhanced reporting requirements that I think are relevant for all of us in our practice, given that we're in March, the T3s are flowing, and there's deadlines coming up there. So just to look at trusts in general, because we have a situation where generally we're telling a lawyer we're designing a trust, and when we look at it in the context of an owner-managed business, there are so many complex tax components that go into that. What are the implications of TOSI? What are the implications of attribution, control, association? So when we're looking at designing that relationship between the trustees and the beneficiaries and how that's going to benefit, we really need to consider a whole slew of tax legislation and what impact that's going to have on our clients. The type of trust we're looking at is a family trust. And again, a family trust is an inter vivos trust, oftentimes the beneficiaries being, close family and people that are going to benefit from this. Why this is also important is when we set up these trusts, we think about the 21-year time horizon that we have. So we're looking at that deemed disposition, 21 years of control of an asset before we have this deemed disposition. And you can probably tell, even if we look at the last 3 years, what can change in a family, in a business, economically, health reasons, structure of a family in 21 years can be significant. So when we think about a 21-year time horizon, the discretionary ability that we have with those trusts become really important. And again, we have to think about that flexibility at the beginning before we dig into the plan. So now that we've touched on, what does it look like to create that trust, the client is usually asking you, well, what's my benefit? So before 2017, when we had the TOSI rules come in, it was very easy to quantify for a client. If we put in this trust, you can sprinkle some income. This is how much dollar value you might save in a year. Clients were very happy with that. I think now, when we think about our strategy, we have to also talk about end game. What are the benefits year over year? What are the future benefits of having this trust in order to explain to, a business person and help them appreciate the benefits that you have here? Because when the TOSI rules first came in, one of the questions was, well, what's the future of the trust practice? Is everybody going to wind up? Are there benefits here? And I think over the last few years, that's where we've built up this arsenal of, there's a lot of benefit here. The 3 areas that I want to talk about are multiplication of the lifetime capital gains exemption, having an optimal structure for purification for both tax reasons and non-tax reasons, and then estate planning considerations that can be really beneficial here. So the lifetime capital gains exemption in 2022 is $913,630, which, is a great number. But if we talk about it in after-tax dollars, what are you saving? At the highest rate, you're looking at about $244,000 per individual. So one, being able to have a structure where you can access the lifetime capital gains exemption is great. 2, if you can multiply it, even better. I want to stress here when we're talking about the allocation of capital gains and multiplying the lifetime capital gains exemption, the importance of having a bona fide situation where that cash is going to the ultimate beneficiary. This is not a tax play where there's, wink, wink, nudge, nudge reporting. It really is important to explain to your client that if a capital gain is going to be allocated, those funds do belong to that individual. So I always like to mention that because it's important to make that distinction. Now, I'm not going to belabor the point of the mechanics of a freeze because I think we're generally, comfortable with that. But I do want to walk through basically a structure and maybe an evolution of a structure so that we can see that benefit. And the structure we're looking at right now is very common. So again, on the outset, X goes out and incorporates a company, wants to start a business, all is well. If we think about going forward, someday X may be able to claim the lifetime capital gains exemption. And I think that's something that's really important that we understand about our clients up front. Is this a potentially saleable business? And if that's the case, we need to start thinking about the structure early on and not someday right before a sale or, a tragedy, God forbid. It's something that we need to think about now, because in the structure as it's set up in this picture, it's great if, they're taking out the money every year, you don't have a saleable business, but there isn't much planning opportunity. Another structure that we see or inherit a lot of times is the structure where a holdco is introduced in between the individual shareholder and the operating business. Oftentimes the motivation here is to move passive assets up to the holdco to separate for business reasons, so liability. It's a very efficient structure for purifying funds from opco to holdco. But does it get us any further ahead in that end game planning, that future planning that we have? And oftentimes the answer is no. So when we talk about family trusts and the benefits that we have here, I've looked at a structure where maybe time has already passed by and there's value in opco. So if it's not set up right at the beginning, we have to find a way to introduce the trust. And this would be the concept of the freeze. So X can exchange the shares. We can do this on a tax-deferred basis and take back fixed value preferred shares. And a trust can come in and subscribe. Now, subject to all of the regular holding period tests, QSBC tests, and the future growth being attributed to that trust, this allows some future growth to attribute to that trust such that you might be able to benefit from the use of the lifetime capital gains exemption. And that's why it's so important that when we look at who are the beneficiaries of this trust and might benefit from this type of structure, and what is the taxpayer act ultimately benefiting when we look at this. Now, what I like to say is let's take it one step further, because if we just look at this structure and we said, okay, we need to get passive assets out of opco, because again, we're looking at this on a regular basis. Our options really are for X to take money out and pay tax, or funds would go out to the trust, and then we've either got the trust paying high rate tax, or the beneficiaries potentially subject to TOSI or paying other personal tax rates. What we see as oftentimes an optimal structure, particularly where the operating company is throwing off excess cash, is a situation where one of the beneficiaries of the trust is a holding company. Now, it is really important to consider, again, many other pieces of tax legislation here. Are you on side for Part 4 tax? Do you have any other considerations? Who are the owners of holdco? What are our TOSI implications? But in general, what this structure allows you to do is purify on a regular basis. So again, purifications are very standard. There are some professional corporations that are limited. They can't have a trust. And there are other strategies that can be used to purify on a tax-deferred basis. But it does require reorganizations, time with your accountant. And again, when you want to stay continually on side and you see your accountant once a year, it becomes very easy to fall off side. In this structure, opco can pay dividends to the trust and out to the beneficiary holdco if set up properly on a tax-deferred basis, on a regular basis, and still maintain that ability with the other beneficiaries as individuals to potentially multiply the lifetime capital gains exemption. Even if it didn't get multiplied, even keeping X's ability to claim their lifetime capital gains exemption by meeting those QSBC tests is a really great part about the structure. So something that I would keep in mind, certainly for your clients. Just to summarize on the optimal structure and what it offers, again, transferring those passive assets on a regular basis becomes really important. You don't want to be in a situation where you're tripping up on a 50% test when you're sailing towards a sale. In terms of purifications, again, when you're going towards a sale, you've got to watch out for 55-2. You've got to look at, potentially safe income on hand on those shares. And I think the structure really does help ease some of that burden of the taxpayer and allow that to happen on a more seamless basis. jumping into estate planning, and again, I've got the same picture here, so I want to talk about it in the context of that owner-manager. It honestly, it surprises me, and sometimes I think we take for granted as accountants or professionals that the average taxpayer, even business owner, may not understand the implications of their death when it comes to their capital assets and the concept of the deemed disposition. So in this case, we've got X owning all of the shares of their operating company. And on their passing, there's going to be a deemed disposition. So we know that we've got all these great post-mortem planning opportunities available to us. You know, there's been endless presentations. They're really great. I would suggest, really understanding those post-mortem opportunities. But it doesn't take away the fact that in that moment, in that time, depending on how liquid your operating company is, depending on what cycle your business is in, it can cause major disruptions and, potentially a cash crunch if it's not available. So when we're thinking about the benefits that a trust might have, think about how we talked about that value shifting over to the trust. And again, the trust, one of those beneficiaries can continue to be that business owner. They are not losing out on that. But if there was to be a sudden tragedy or death, there would be maybe at least an opportunity to delay or not have that cash crunch or that immediate necessity to start looking at whether, some loss carryback or pipeline planning needs to be considered. I want to mention special purpose trusts, and I think this is relevant for both, owner managers and, an average individual that maybe has accumulated wealth. When we look at families and businesses, there can be, second, sometimes even third marriages are very common right now. And we're seeing, multi-generational families, kids, grandkids, and it's really important that the wishes of the business owner on their passing are able to be completed by their executor. And when we have businesses especially, and we've got someone running the show, sometimes these types of trusts, alter ego trust, joint spousal trusts, can make sure that the assets or the benefit during certain lifetimes end with the person that is really intended. So again, complementary to the rest of estate planning, I think sometimes these trusts are overlooked as an opportunity. Again, the client is generally going to say, well, there's compliance related, and I'm going to talk about that in a second. What are my benefits on an annual basis? Because that's what we want to see. So again, it's talking about that end game and what can you avoid and what can you benefit. There are a number of non-tax reasons to use a trust and considerations. I'm going to leave this here, but I would recommend talking to a family law lawyer, talking to your corporate lawyer. There's a number of reasons to consider as well when, talking to your client about this. One opportunity that I wanted to bring up today, because I think it's so topical with interest rates, the prescribed interest rate being 1% right now, and also the fact that, we see that the interest rates are on the rise, is the concept of prescribed rate loans in the context of a trust. So I think for a long time, these have been very popular between spouses to avoid attribution. So again, we can't give money to your spouse and have them earn that income without the attribution rules coming in and kicking us. A trust, the type of arrangement, it's also possible to use that in the context of a prescribed rate loan. And where that's beneficial, again, is where we've got one individual who's, amassed a certain amount of wealth, cash. Maybe they just sold their business and they're wondering, how am I going to invest this? Maybe they've got some other source, but, they're paying income tax at that top rate. And maybe they're supporting a bunch of other people or, giving money annually to, other family members or spouses or whatever the case may be. So this is where you usually get your client's eyes to light up and they're going to say, okay, you can show me the savings. And just like you would set up a trust for an owner manager, the relationship between the trustees and the beneficiaries and how you design that becomes really important with what are my opportunities for allocating income? What are my opportunities when we go down the road and we start to consider estate planning once we've got, again, wealth accruing inside of this trust? And I think it can be a really great tool, not only for saving tax on an annual basis, but considering where's your wealth growing and what flexibility do I have going forward. We talk about the 21-year time horizon. I can tell you I have 2 small kids, and they've changed significantly in the last 5 years. So 21 years is a really good time to be able to control those assets rather than maybe a straight gift. So in the right family circumstance, it can add a lot of value, again, outside of the income tax planning side of things. So again, ideal candidates, there's a large amount of cash, they're paying tax at the top rate. And again, really important that the beneficiary to whom the income is being allocated is the recipient of those funds. It's very important to appreciate the structure that is in place and remain compliant there. I'm down to my last couple of minutes, and I know that if you are, running a tax practice or an accounting practice, you're probably in the middle of March thinking, I've got to get my T3s out. And I thought it was really important to touch on the enhanced reporting requirements for trusts. So I know in our practice leading up, throughout the summer and fall, we were accumulating information. So information where, once upon a time, a trust may not have even had a filing requirement. And all of a sudden, the settlor, the trustees, the beneficiaries, we need to start disclosing their names, date of birth, social insurance number, tax residency. And there was a bit of a change, only recently where the, prescribed form wasn't available. It wasn't going to change for this year, but, that is still coming. And again, once upon a time, maybe there wasn't even a filing requirement. And now we've got a situation where CRA is going to start imposing penalties where this information that they're requiring hasn't been disclosed. So when you think about why the CRA is starting to collect this information, if you go right back to the beginning of my presentation and we talk about TOSI and attribution and association, the power of that information that they're collecting can be very significant to a corporate group. And I think that's why the push for that penalty and that compliance in that regard becomes so important. So as you're looking at, trusts that already exist and you're designing new trusts, I think that's something that we really have to keep in mind as practitioners. It's on the horizon. It is coming. Just on Tuesday, when we were doing the sound check for this presentation, CPA Canada released a news update. And in the news update, it talked about the e-filing capabilities and requirements for T3s. So I think we'll all agree that it is a welcome change that we can e-file, a significant number of T3s. The old world of paper filing everything, was a hassle. It wasn't great. They've now got an actual T183, so we have clarity on, what approval, what signatures are required. So that's fantastic. One thing, though, that, came up on this news release that I thought was really interesting was there's actually a requirement to upload supporting documentation with that T3 that you've e-filed. So it's actually through my account or represent a client that in addition to electronically filing your T3, which, usually we say, okay, we've e-filed it, our compliance is done unless something is requested of us. There is actually a requirement to upload documents, anything to support that T3, elections, any of the questions that they're asking for on the jacket. If there's supporting documentation, they're expecting that it is going to be uploaded. So I would recommend that everybody go take a look at that. If you are, racing towards that deadline with the rest of us, there may be a compliance piece that is, relatively new guidance from the CRA. So thank you so much. I especially appreciate everyone's time this time of year. I know it's super busy. So, thanks for tuning in.
Jenny, that is great. Thank you so much. Again, you had a few topic ideas, and I'm really glad you selected this one because I needed to learn some of that information. Thank you very much for bringing it to us.
Thanks for having me, Dean. I appreciate it.
Great. All right. Our final speaker is the Managing Director of Tax and Estate Planning at CIBC. He also writes a column called Tax Expert for the National Post, and it does a fantastic job of explaining common misconceptions for Canadian taxpayers. I constantly find myself reading it and then sending it to this client and sending it to that client so that they read it too. He graduated from McGill with his Bachelor of Commerce. He has CPA designations from Ontario and Illinois, and CPA Ontario has actually recognized him with their Award of Distinction for having made an early impact on the profession. You probably recognize him for his from his guest appearances on BNN, CTV, CBC The National, The Fresh Prince of Bel-Air. Okay, I'm not sure about the last one, but it's possible he is on TV a lot. And we've got him here today to give us his tax planning strategies for 2022. Please welcome from CIBC, Jamie Golombek.
Thanks very much, and thanks everyone for joining me today. I'm going to take exactly 25 minutes to go through what's new for 2022, what we need to know as accountants on the tax front. So I've divided into 3 areas: the election tax promises, in other words, things we could see in an upcoming budget, which is rumored to be the last week of March, early April. An update on where we are on the tax numbers for 2022, including a overview of our tax rates, both personally and corporately. Of course, many of us have clients that are small business owners, and we've heard a lot about that so far today from our previous speakers. So looking at some of the tax rates, some of the integration, the issues of, bonus versus salary, leaving money in the company, TOSI, where are we on all that stuff, including the passive income grind, which does not apply in Ontario provincially. We'll see some interesting results there mathematically. We'll take you through integration as well for investment income. And then just a few at the very end cases that came out sort of late last year, and some CRA pronouncements that's worthwhile knowing on the personal tax side. So let's just jump right in. The election tax promises on the Liberal side, of course, they're promising a minimum tax. As accountants, we don't really know what they're talking about. We already have a minimum tax. We have an AMD. So this is some new type of minimum tax. The results, I guess, we'll see in the details. The tax-free first home savings accounts, we don't have any details other than the fact that individuals under the age of 40 will be able to contribute $40,000 to an RSP-like vehicle to buy a first home, but when they take it out, will come out like a TFSA and be tax-free. The rumor is that we'll have details of this in the upcoming federal budget, and the program will begin to be implemented on Jan 1st, 2023. We've also heard rumors of the anti-flipping tax. If you own a principal residence for under 12 months, they will deny you the principal residence exemption other than certain criteria. Again, this is all promises. We don't have legislation on this stuff. I'll talk about that towards the very end in a case that came up last year when an individual owned multiple principal residences and was actually denied. So CRA wants to be able to legislatively deny it rather than relying on case law. We already heard, of course, the home office expense deduction that's been bumped up to $500 from $400 this year. And there's some changes there being suggested on the banks and insurance company side. On the tax credit side, more and more boutique tax credits. I'm not a fan of this stuff, but this is what they're promising. Things like a multi-generational home renovation credit, a home appliance repair credit that'll give you $75 for people using surrogates for IVF, being able to claim those as medical expenses, and even a career extension credit. So again, we may see details of that for 2022. None of this applies as of today. Now, why do I bring up the NDP? I bring it up specifically, of course, because we did see the passing, as we earlier mentioned, the truckers' convoy in Ottawa, the passing of the Emergency Act. We won't get into that today, but we know that the NDP did vote with the Liberals, and therefore we are concerned that some of the promises in the NDP platform could ultimately make their way under a bargaining agreement with the Liberals on other legislation. We know the big one, of course, was the 75% inclusion rate. I did a poll on LinkedIn recently, and it's kind of 50-50 as to whether they would do that. On a comforting note, there was a comment made a couple weeks ago by Minister Freeland specifically saying that she would not be going there. So we take some comfort in that, at least for now. We'll see what the deficit looks like in an upcoming budget. The top marginal rate, 33 to 35%, is being proposed. A wealth tax on individuals over 10 million. I'll come back to that in just a second. And then some changes on corporate tax rates. And again, foreign buyers property tax. This whole wealth tax issue has been popular. There are only 12 countries that had a wealth tax going back about 30 years ago. Those slowly started to disappear. So if you fast forward to 2000, there was only a handful of countries that had it. In fact, if you go to today, the number of countries that still have a wealth tax in the OECD is only 4 countries. Would Canada become the 5th country? I really don't think so. So again, there's been a lot of talk about a wealth tax. I don't foresee a wealth tax in Canada. There's all kinds of issues with double taxation. It only affects a very few people because of the high exemption. And also you have a lot of illiquid assets. How do you value private companies? How do you value real estate? How do you value artwork? things like that are non-liquid. So complicated, controversial, unlikely, I think we'll see that. Let's get into some real numbers for 2022. Let's start with personal. Let's go to corporate. So personal side, we have 5 brackets for this year. They've all been indexed to inflation. We start at income up to $50,000. We take you right up to that top federal bracket, income over $222,000, starting at 15%, going right up to 33%. That's, of course, only half the story, because we have to add to the federal rates, the Ontario rates. You get this mess in Ontario, because you got 5 federal rates, 5 Ontario rates, 2 levels of surtax in Ontario. You get 12 or 13 brackets, something like that. And you can see that the amount of tax that you pay, the rate that you pay, depends not only on the amount of income, but on the type of income. So again, going from eligible dividends from public companies like CIBC to other than eligible for small business rate income, tax at the small business rate, to capital gains at 50% of the normal rate, and then other income would just be your regular standard marginal rates, other income, investment income, salary income, employment income, self-employment income. So you can see that the rates really range from 15 to 53%, or from 0 on dividends to 39% on eligible dividends. So people are focused on tax reduction for sure. Ontario stacks up as one of the highest tax provinces in Canada. Newfoundland and Labrador, you're now hitting 55% with their new surtax high-level tax bracket, 54% in Nova Scotia, and then we're pretty much tied with BC, Quebec, and New Brunswick. Alberta, if you recall years ago, which had that flat tax that used to have that very low rate, is still the lowest rate, one of the lowest rate provinces in Canada at 48%, giving you about a 5.5% advantage there over Ontario. Going to now registered plans, quick update there. We've written a bulletin on this last year, going all about how you can build wealth using multiple types of registered plans. Obviously, we start with the RSP, this year's limit, $29,000. Many of our clients have already made this year's RSP contribution if their earned income last year was at least $162,000. A recent case, by the way, clarified, I wrote about this in the paper, what is earned income? We know it's employment income, self-employment income. We probably know that it's rental income. It does not include a retiring allowance. There was a recent case that once again confirmed that. The TFSA, again, what is the TFSA cumulative limit? $81,500. That's illustrated by this chart, but it's not for everyone. So if you're working with younger clients, remember, they don't necessarily have 81.5 if they're under 31 years of age. Because remember, the TFSA only began in the year 2010, right? Or 2009. So effectively, you really have to look at the year the client turned 18. So we use this handy chart to sort of give us that cumulative limit. Great opportunity, no attribution. You can gift your spouse or partner money. They can do a TFSA. So this is really a $163,000 opportunity for a couple. Everyone should be taking advantage of that. Some debate whether a U.S. person should have the TFSA. Not sure I agree. I think it's fine as long as you work out the math on the credits and you do the reporting on the 3520 or 3520A. I think at this dollar level where we're getting 6-figure TFSAs, we do have many U.S. citizen clients that have a TFSA. On the RDSP front, again, the numbers have increased slightly in terms of the eligibility for the grants. The ability to put out $200,000 away for an individual with a disability tax credit, $70,000 of grants, $20,000 of bonds. That's $90,000 of money. It is income tested, but once that disabled beneficiary is at least 19, you use their own income. So if their own family income is relatively low, let's say under $32,000, they're going to get the maximum credits. And if you just do some basic math on that, someone who eligible for these generous credits over 20 years puts in $1,500 a year. That's the red. You get the $70,000 of grants. You get the $20,000 of bonds. If we assume just a 3% compounded annual rate of return at the end of 20 years, we're going to have about $166,000 in the RDSP. That's by putting in only $30,000 of our own money at a 3% rate of return. So that's equivalent to basically a 14.5% rate of return. So we love the RDSP, but again, you have to qualify for the disability tax credit, which is a whole nother lecture in terms of qualification for that. Let's now turn to corporate. We know many of people listening today deal with owner manager clients, CCPCs that have private corporations. Let's get right into some of the numbers. We just updated a report, buy bonus. Does a business owner want dividends or a bonus? Do you bonus down? What is the strategy here? And let's take you through some numbers. So to really understand this, we go back to the basic principle of integration. We'll use Ontario as our example. You have a CCPC earning $100,000 of small business rate income, corporate tax rate of 12.2%, yields after tax income of 87.8. You want to take that out of the corporation. We know that is considered to be a non-eligible dividend because it was taxed at the low rate. You pay high rates of personal tax on that. If you assume the top rate, you got about $42,000 of tax. That leaves you as the business owner with $45,900. If we contrast that to the same $100,000 earned personally, not inside of a corporation, if we again assume the top marginal rate in Ontario of 53.53, we'd have after tax of 46.5. If you compare that now with the corporate income, you can see for 2022, there's just a very small tax cost of having active business income earned in a CCPC in Ontario this year, but there is a massive tax deferral of 41.3. So this is where I begin every conversation. I put this up in Microsoft Teams. I did it yesterday with a high net worth client that didn't understand how his holding company works. I'll show you again how we use it for investment income. The numbers are very different. But this is where I begin every conversation with a client, including a professional corporation. Do they really understand why they have the corporation in the first place? Because if they're spending all the money and paying it out every single year, why do they even bother? Now, there are reasons for liability. You can't get around that on a professional corp side. But at the end of the day, the main advantage, I think you'll all know this, is the tax deferral, which this year in Ontario is 41.3%. And the opportunity to leave that money in the corporation for years, decades, or a lifetime is a substantial tax deferral advantage that far outweighs the slight cost of negative 0.6% of initial taxation. Now, we do the same exercise all over again. I'll go even faster now. $100,000 at the high rate income of 26.5%, yields 73.5. Now we have eligible dividends. The eligible dividends are taxed at 39%. We get taxed about $29,000. We're net 44.5. If we compare that to the $100,000 of income earned personally, again, at the top rate of 53.5, we net 46.5. So you can see that here we have a slightly higher cost. Instead of negative 6.6, we have negative 2, but our deferral drops substantially to 27. So the general rule is, yes, you can continue to leave the money in the corporation. You no longer have to bonus down for the small business rate because, again, we have a slight cost on the integration side, negative 2, but you will still have a significant tax deferral by leaving it in the company. So this idea of bonusing down may not work anymore in terms of the opportunity to leave the money in the company. So that's where we are on both small business rate and general rate income in Ontario for 2022. The question people keep asking me is, what about these new passive, not so new, right? 3 years old, passive income tests. What do you do about that in terms of CCPC tax planning? So you remember that when the rules came in, there's a grind to the federal small business rate when your adjusted aggregate investment income, your AAII, is more than $50,000. And in fact, you lose all of your small business limit when you have more than $150,000 of passive investment income in the corporation. Now, interestingly, Ontario did not follow the rules. And I have published an article back in 2019 when I first discovered this, and I republished it again in April 2021. It was co-authored with my friend and colleague Jay Goodis at Tax Templates. If you're not familiar with Tax Templates, Google it later. Great company. They do all kinds of tax Excel spreadsheets to help us as CPAs be able to calculate tax owing integration. They've got tax calculators. We use their service extensively at work, but we actually collaborated together on running some numbers. And you actually benefit in Ontario by losing the small business rate. And the reason for that is that Ontario didn't follow the federal regime. So you get a very interesting result, because if I have $100,000 taxable in Ontario because I have the small business rate Ontario but not federal, you get a very, very interesting result because your tax rate is somewhere in the middle, about 18.2. You have $81,000 of dividends. Again, when those dividends are paid out, those are eligible. You get personal tax on that. And effectively what happens here is if you compare that to the personal result, in the end, you can see that there is actually a tax savings. I mean, this is crazy, right? You have a tax savings by losing the small business rate in Ontario. The Ontario government knows this. They haven't done anything about it. It's been 3 years. Yeah, our deferral is reduced from 41 to 35, but we're actually saving money by losing the small business rate. And the reason this works is because the dividends are now considered to be eligible. The math is very interesting on this. So it's worth looking at. In fact, this is the summary chart here. So if we looked at the three different types of income, we have the corporate rates, we have the integrated rate, and we compare that to the personal rate. And you can see that with the small business deduction income, you have a slight cost. With general rate income, a bigger cost, but you actually have an advantage when you have CCPC with passive income more than 150. You've lost the small business rate federally, but you haven't lost it in Ontario. So interesting anomaly. We're not worried about telling our clients in Ontario, at least, about losing the small business rate. However, if we deal with other provinces too, other than Ontario and New Brunswick, people are still worried about it. So how can we reduce passive income in a corporation? Number one, we use investment strategies, buy and hold. We deferred gains. We use tax-free withdrawals to take out surplus. We make donations corporately to get deductions instead of personally. We continue to maximize RSPs and TFSAs by taking the money out of the corporation. We use corporately owned permanent life insurance. We can use an IPP, an individual pension plan, to move some of the corporate assets into a registered plan and therefore not accumulate investment income. And in some cases, maybe you'll use an RCA, although I can tell you I haven't seen one in years. We've written actually a couple of pieces on that, proving mathematically that every business owner should be maximizing her RSP and her TFSA. In other words, the ability to take the money out even by way of a taxable dividend if necessary to make an RSP or TFSA contribution does make sense mathematically, because remember, you're earning tax-free returns inside those plans, whereas investment income in a CCPC is taxed at over 50%. Now, let's talk about holdcos, right? A lot of our clients have these holdcos because they sold the opco, or maybe they've got the investment portfolio sitting there. Maybe it's a sister co, as we saw earlier, used as part of a purification strategy through a family trust. The problem is that investment income is not taxed very well, right, inside of a corporation. If we run those same numbers again of $1,000 of investment income, we've got a tax, right? We've got that 50% tax. Part of it is refundable, right? So assuming we pay it out, we get the RDTOH back. Effectively, what happens is we get the refundable tax back. We add that to the after-tax amount. We pay out now a non-eligible dividend because it's from investment income. You pay tax on that rate at a very high rate, right, 48%. And effectively, you're left with tax after-tax cash of $421. And again, if you ran those numbers personally, you'd have $465. So you can see that in Ontario this year, you have a negative cost of 4.4% for every dollar investment income with a very minimal deferral. That's why I tell people all the time, don't incorporate. In other words, if you've got an investment portfolio, it usually doesn't make sense to incorporate it because of this negative cost of 4% a year with basically a very minimal tax deferral. You know, we do the same thing with capital gains. The only trick with capital gains, as you know, half is taxable, half's non-taxable. You have some capital dividend account that you can pay out. We get the refundable tax back. Effectively, when you run through the math on all of this, you're going to see that you pay out a $500 tax-free capital dividend or $400 taxable dividend. And when you actually run the math on that and you compare the after-tax dollars, you're going to look at, again, almost perfect integration with a slight cost of negative 2.2. And that's just half the negative 4.4, right? Again, the tax deferral is minimal. So again, investment income in a corp in Ontario 2022 doesn't really make a lot of sense. Foreign income is where you really get hit, right? So if you got these US dividends coming into your CCPC and you get your 15% withholding tax, you get a bit of a mess, right? Because of a quirk in the calculation of the refundable tax. So again, without going into all these details, when you actually run the math, I'll show you the summary in just a second. You get this non-eligible dividend. You pay a very high rate of tax on that, of course. And when you compare the two numbers together, believe it or not, your total integrated rate is over 60%. So in other words, effectively, you're getting $358 versus $465. It's costing you an additional 11% on top of the 53% to earn foreign investment income in a holdco. So again, you got to be very, very careful with that if you have substantial foreign income subject to withholding tax. And I've just summarized all of those last 5 minutes on one slide because I want to move on. This shows you, again, my corporate tax rates for different types of income, my fully integrated rate. You see that second one, foreign income, 64% is my integrated rate.
on US dividends in a CCPC. Compare that to my top personal rates, showing you my tax deferrals and ultimately my tax cost on the very right. We know with dividends, other than the Part 4 tax, there's no real cost to you if you pay it out the same year. All right, we're going fast. One more comment here on CCPCs. Remember the TOSI rules, right? Tax on split income. You got to be very careful about that. No real changes there. Just a reminder that there are exceptions. Number 4 is the exception people forget about. CCPCs are still very valid for income splitting with dividends in the case of retirement. When you've got your specified individual as a spouse or the common law partner of the source individual, once that individual is 65, even if the spouse is 25, you can do dividend paying income sprinkling without worrying about TOSI. So please don't forget about exception number 4. Last 4 minutes. I have 4 minutes, I'm told. 4 minutes. A few cases, right? Some highlights, some warnings as CPAs. Number 1, the T1135. Don't get me started on the T1135. I was researching this yesterday because we're actually lobbying the government to try to, get rid of this T1135 nonsense for, U.S. securities held in a Canadian brokerage account. Doesn't make a lot of sense. Here we had someone who filed late, 166 days late. He didn't know any taxes. So he says, you know what? So what? I'll file late. Who cares? No penalties. He was wrong. Because he was over the 100 days late, he was hit the $25 a penalty. He got a $2,500 penalty. He requested relief. He went to court. He said, no, it's not fair. I was helping with health issues. Court says, I don't care. Don't care. It's reasonable for the CRA to conclude that the 1135 was not onerous. You should have done it. You should have made arrangements. You should have filed. Period. You should have filed. $2,500 penalty. Too bad for you. The Froling case, right? Individual receives an inheritance, wants to maximize RSP, contributes to his RSP, contributes to a spousal RSP, got confused, right? Didn't understand his room, his wife's room. It's all the same. It's different. Add it together. Anyway, got hit with an over-contribution tax. It was an honest mistake. Court says, too bad. You're innocent. You made a mistake. You should have known the rules. You used spousal RSPs before. You get hit with the over-contribution tax. So no mercy there in court, in federal court, asking for judicial review of the CRA's decision. The Rempel case. Here you had a guy who over-contributed to his TFSA. TFSA sent him a notice. It set the penalty. And at the end of the day, he signed up for the automatic emails, right? Problem is, he didn't get the email. He said he didn't get the email. The email went to junk. Who knows what happened to the email? Court says, too bad for you. Your mistake. You over-contributed. You don't monitor your email. That's not the CRA's problem. You got to pay the penalty tax. At the roundtable last year at STEP, I posed the following question in advance. They were answered. Let's say someone contributes to a TFSA by mistake. We know that if you withdraw the money with due speed, you can actually eliminate the penalty tax by writing administratively to the CRA. The problem is, what if you contributed to the TFSA, it was an over-contribution, but your investment goes to zero? How could you stop the penalty tax if there's nothing to withdraw? And the CRA said, too bad. You can only reduce it when you start building up new TFSA contribution room. My advice is, you know what, if this is you, get a remission order, because this would be a very bizarre circumstance, and I don't think it's fair to be penalized. And finally, this the Wall case was this issue I talked about earlier. We had someone who claimed the principal residence multiple times over 3 homes, 6 years. He basically claimed the principal residence exemption, and he said he wasn't a builder and therefore he didn't charge GST, and CRA assessed him for unreported business income, forget capital gains, business income, and GST, and court says, you know what, the homes were not ordinarily inhabited, and therefore you're in the business of development of real estate, and therefore you don't get to claim the exemption. He lost the case. This is the Federal Court of Appeal, by the way. So maybe that new legislation will stop some of this case law. With that, I'm told I'm completely out of time. Thanks very much.
Jamie, that was amazing. That was very intense. I'm going to need to listen to that and watch that through one more time. My podcast feature on my phone allows me to speed up the audiobook I listen to. I'm going to have to use it to slow you down, though, and really really dig into that. But we actually do have a couple more minutes. I think you ended 2 minutes early. So tell me, for budget coming up, what would be Jamie Golombek's number one wish?
Well, I wish they would stop with all these new credits, but that is not going to happen. I mean, there's no chance, right? If you just, we saw the forecasting of more credits, and even this first-time home thing. Like, is that really going to help people buy a home? Certainly not in Toronto and Vancouver, right? Yeah. 40,000, whatever the number is they're proposing, right? So you're just adding more complexity, another registered plan. Like, do we need something else in addition to the RSP, the TFSA, the RESP? Like, there's so much already. There's just so much complexity in the tax system. I think all our audience would agree with that. Anyone who's filing these tax returns, it's just so complicated. 132 different deductions, items, credits that you could possibly claim. It's just overwhelming.
Yeah. And with regards to this potential house flipping legislation, do you have hope for that? Because for people in my line of business, tax dispute resolution, like, we're seeing files all the time on house flipping. I think Caitlin alluded to it earlier, that this letter campaign out in BC. Do you think that legislation would just simplify all this?
I think it would. I think it just basically draws a bright line test. You bought your home, you sold it within a year. You don't have a good excuse like divorce or moving or a job, or you lose your job. You just can't claim it. So hold on to your house for more than 1 year, or you're a builder, right? So I think it's a bright line test, right? Because I mean, what a time. And look, as you know, before 5 years ago, this was never an issue because you never even reported. In fact, the government told you, do not report the claim of your principal residence unless you're claiming a partial exemption, right? And now you have to, as of 5 years ago. So all of a sudden the CRA is cluing in to all these sales of residences. And of course, we know this is easy money because you've seen the escalation, certainly in markets like Toronto and Vancouver. This is big money, right, for the government. And we know, like, I hear about it, these quasi builders that actually don't have another job that just renovate and they just decide to move coincidentally every 18 months. Like, we know they're in the business of personal home renovation.
Yeah, totally. Well, I've spoken to real estate agents too here in Ottawa, and they, Royal LePage flew me out to Halifax one year to speak at their annual conference, and I was speaking on this issue, and their jaws dropped, the real estate agents, because they always thought that there was this 1 year bright line rule, and if you made it past 1 year, then you could sell a house every 13 months. And when they're told that that's not the case, it's quite shocking for them. So I do think some simplicity to this would be a major benefit in the long run. Yeah. Okay. Well, listen, thanks so much. We really appreciate it. It's a big deal to have you here, and we'll continue looking for your article in the National Post.
Thanks, Dean.
Bye for now. All right. I think I'm going to listen to all of our speakers' presentations one more time for sure. That was an incredible lineup. Thank you so much to all the speakers. You really nailed it. We're grateful for you. Shout out to Khaled Abdel-Jabbar and Michael Curran from the Ottawa Business Journal. They produced this event and took our audio-visual stuff to a whole new level. Khaled really walked me through this stuff. So thank you to him in particular. We're grateful for that. On behalf of Lisa Allen, who's our chapter president, and Richard McNeil, who's our programs committee chair, I'd like to thank you, the audience, for attending. It's great to have you. We had, I believe, around 180 people register, so that's wonderful. And we look forward to seeing you again in person, hopefully in the not too distant future. But in the meantime, it's great to have you, great to connect with you just like this. So thank you for attending. Thanks to our speakers. Please fill out the survey. We look forward to hearing your feedback, and take care of yourself. Bye for now.